Today, legendary investor Jeremy Grantham unleashed a new macro perspective of the global marketplace. Last week, the GMO chairman warned that we are in the first worldwide bubble, and it's reaching across all asset classes, at least in his view. Is he right? Bryan is the president and founder of Global Financial Data, says no way. But Barry Ritholtz, chief market strategist at Ritholtz Research and Analytics, says he could go with about two-thirds of that argument. Gentlemen, good morning to you both. Thanks for being with us.
Good morning, Carl.
Bryan, let me start with you. Let's take a quick look at a quote from Grantham. As we know, legendary value investor. He says, quote, new global money flows have probably created the first truly global bubble almost everywhere in almost everything. We should fasten our seatbelts. It's likely to be a bumpy ride. What do you think?
Well, I think the fact that the investments in financial and other assets has been spread throughout a large number of assets could actually work against that because it shows that the money has been well diversified. With bubbles, you usually have it into specific classes that gets overdone. We have had that in specific markets, such as the Chinese market earlier this year, the Arab markets a couple years ago. But I think the diversification makes it almost less likely that it would occur.
Interesting. Barry, he says you need two things to have a bubble, right? Good fundamentals and easy money, right?
That's right.
We've got both.
That's right. Globally, especially, if you look at what's been going on in Asia and now Europe, the fundamentals are very good. And if you look at the amount of credit and leverage and liquidity, I mean, the front page of today's Wall Street Journal is all about how leveraged up all these private equity and hedge funds are. That combination, easy money, a lot of leverage, and good fundamentals lead to a point where risk premiums just shrink and the animal spirits are unleashed. Yep. And I think Grantham has a very valid point with that.
But you don't agree with him across the board. Where do you part ways?
You know, I never bought into the housing sector in the U.S. as a bubble. They do have an intrinsic, outside of Love Canal and Detroit, most houses have some sort of value. It's not like a company whose only value was a sock puppet. You look at the .com, that was a very, very different era. But when you look across the board, and whether you're talking about modern or classic art, when you're talking about a variety of different commodities, and especially look at the Chinese market up 180% over the past year or so. I mean, some of the numbers are just off the charts. He's not just a value investor. He's a big quant, a big believer in mean reversion, and he says when the valuations get too stretched, we know what happens. Eventually, they revert back to the mean.
Yeah, Bryan, in fact, he even points out that he says we're probably in for an extended period of what he calls mispricing, meaning this isn't going to bust anytime soon. Do you think that rings of a value investor who's looking around the landscape, sees Dow 13,000, new record highs every day, and simply has to say something to make sense of the fact that the market's not going his way?
Well, I think it's all a matter of degree. Are we to the point where we're at a bubble, where we have the blow-off top, as he talked about? And if you look at bubbles in the past, you have to have a definition. A contraction's 10% decline, a bear market 20% decline. But if you look at the bubbles that have occurred in the past, such as the internet stocks after 2000, Nikkei after 1990, or the U.S. market in the 1930s, you had a 75% decline in those markets when the bubbles burst. So to really meet his definition, you would need a 75% decline in global world markets to have a real bursting out of a bubble, and I see that unlikely.
Yeah, nobody wants to think about like that.
No, not at all.
Carl, let me just remind everybody, in June 2000, he had a very famous debate. This is Grantham with Henry Blodgett in Forbes, and at that point he said the S&P was overvalued by 50%, the NASDAQ was overvalued by 70%, we're taking our chips, and remember, they're mostly a long-only fund. We're taking our chips and we're investing in timber and energy and emerging markets. And so it's not that he's run out of places to put money. He's just put his money mostly out of U.S. equities, and he's outperformed for the past 7 years.
Yeah. Gentlemen, we'll keep an eye on it. Thanks for your insights, both Barry and Bryan.